Saurabh Mukherjea joins us. Let's connect with him to understand that his view on the market, where is he picking his spots, and why are financials underperforming. Saurabh, fantastic to have you back as always. Thank you for joining us. Uh, Saurabh, there seems to be a bit of a change in the macro narrative, whether it is local or global. Uh, Locally, you can blame it on tomato prices and onion prices. Globally, we could blame it on what's happening to the dollar index and how China is moving.
I think the macro narrative, I think, is probably the best we've ever had it. I think I can't remember a juncture in Indian history where the economy is running at 6.5%. We're close to the top of the we're close to the top of the interest rate cycle, and the Chinese economy is blowing up in front of us, right? China blowing up, the implosion in China, the fact that they're struggling with GDP growth, with exports, with employment. I think that has massive implications. It's almost inevitable that the Chinese economic slowdown will exert massive deflationary forces across the world on commodity prices, on oil prices. I'm not so sure central banks or the bond markets are reflecting that just yet. Um, uh, China's economic boom over the last 12, 20 years supported commodity prices. I think China's economic unwinding, perhaps its economic collapse over the next 10 years, will have a deflationary impact. As and when that becomes apparent to bond markets and to central banks, I think the narrative that we are close to the top of the interest rate cycle will solidify, and therefore the jitteriness that we see around interest rates, I think, will abate over the next 12 months.
Saurabh, everybody's excited about the way our financials are moving. It's a consensus view, and it's a space where the growth, I think, is evident. But somehow, if I look at the performance of financials, and especially for large cap banks, they've been quite numb this year. The contours of growth are favorable. The valuation stack is exciting and not stretched. Yet the price performance in this year for the large cap banks has disappointed.
And part of the reason for that is the funding conditions are reasonably easy for the lending ecosystem. So whether I look at NBFCs or the banks, raising money primarily CASA money or indeed wholesale market money has been reasonably easy. And whenever you have that, Nikunj, whenever getting access to funds is reasonably easy, it's very difficult to separate the men from the boys, the women from the girls. What we will need is some sort of shock in the system around either loan losses, around some development of bad news around credit quality, for the market to differentiate between, say, the HDFC banks and Kotak banks on the one hand, and say the PSUs on the other. At the moment, the market is saying, why should I buy private sector banks if the PSUs can deliver stellar profit compounding quarter after quarter?
Hi, morning. I'm quite intrigued to see that you're actually calling specialty chemicals as a preferred sector at a time when just about every player has come out there and given a guidance card, talked about a gloomy scenario. Is this a buying the fear strategy?
No, so specialty chemicals, I think people aren't drawing the distinction. Agrochemicals, China is dumping globally. Agrochemicals are therefore under pressure. So, for example, we don't have SRF, but I think it's a high-class company. The SRF management has been clear that China is dumping, and that's exerting pressure on SRF's profits. But in pharmaceuticals, medicines for human beings, there is a shortage. America is going through a massive shortage in, for example, oncology drugs. In contrast media is the stuff we have to consume before an MRI scan. And therefore, what we are seeing is the API space. The API space supplies into the pharmaceutical space, and the intermediates which go into APIs. There is no global glut there. We are not seeing price pressure on API. And as I've said several times on your show, Aisha, China makes 70-80% of the world's API. If India can grab even 10% of that, our API industry doubles. So we quadrupled our position in Divi's lab in November, December last year, and we're continuing to try to make more investments in this space, the space which goes into APIs, intermediate companies. So alkylamines, for example, remains a large holding for us, and we're continuing to look at more companies there. We spent a lot of time talking to pharma ecosystem players in America and India. We are not seeing price pressure in the pharmaceutical space. There is pressure in the agrochemical space. That's a very distinct industry.
Saurabh, tell me, after the peak summer rally of this year, in the recent aberration that we've seen in the markets, have you made any new additions, be it the Little Champs portfolio or any large caps?
So we're actually making several additions to Little Champs. I think the jig trainings that you guys were highlighting a few minutes ago, we're kind of quite enjoying that. So the one I can talk about is RHI Magnesita. So we've added RHI Magnesita to Little Champs portfolio. This is actually very similar to what we did with GMM Pfaudler 4 years ago. So RHI Magnesita makes the refractories, which go into, this is the kind of ceramic lining, the brick lining, which goes into steel plant furnaces or cement plant furnaces. This is the world leader. They have around 35% share globally. This is the India leader. They have 40% share in India. Good gross margins, 40% gross margins, 15% operating margins, around 30% ROC. Near debt-free company. It's an Austrian parent, listed in Austria, and the Indian subsidiary is what we have invested in over the last couple of weeks.
In your thoughts, Saurabh, on the kind of trend that we've seen with these record bulk share sales and of the promoters as well that have been recently offloading shares of their company, the trend that we've been seeing over the past few months. Just wanted to get in your take on the same.
I think the way I'm seeing it is this is sort of one cycle of investing broadly coming to an end. So if you take, again, just to reference our investment in GMM, and this I'll stress here, the stocks I'm mentioning, I'm invested, my parents are invested, and our 10,000 clients are invested. So just to sort of reference GMM, DBAG, the private equity firm, entered GMM 10 years ago. Typical private equity investment cycle is 7 to 10 years. And DBAG therefore exited to Chris Cap. So DBAG sold their position to Chris Cap, I think last week, right? So I don't think that's good or bad for GMM. It's good at one level, the overhang is gone. But this is a perfectly rational cycle. A generation of investors entered 5 to 10 years ago. They're gradually getting out. I think when I was waiting for you guys to talk, you mentioned about a private equity firm exiting Amber. I think this is a perfectly rational cycle. I entered 5 years ago. I've made my money and I'm looking to exit. In fact, we too are doing that with some of our small and mid cap investments as we refresh the small and mid cap portfolio.
Saurabh, what could be the trigger now for the market? Earnings are good, inflation is benign, macro, you keep on getting ups and downs here, but in general, macro is steady, flows have been decent, the outlook by corporate India is not that bad. So some would say that for markets to now move higher, what is next?
I think if I had to sort of pick one positive trigger and one negative trigger, the positive trigger I would say is the China play, right? Because the scale of China's unwind is such that I find it hard to believe that it will not trigger broader corrections in commodity prices and then onto inflationary numbers, both for America and for India. So I think that's the positive trigger to look out for, Chinese unwind leading to deflationary impulses the world over, which then leads to abatement of concerns around interest rates. The negative one, I have to confess, in India's case, I think we've got so many elections ahead of us. We've got 5 assembly elections through the winter, and then obviously the big one in the summer. We are getting the foreign investor community asking us questions around the election piece. And it is what it is. We'll have to deal with that. I keep emphasizing to foreign investors that ours is a robust democracy. And we go through elections every 12 months. We go to some sort of major elections or not. But all of that being said, I think there will be a degree of concern as we go through the election cycle in India.
Saurabh, does it intrigue you, the underperformance in HDFC Bank? I mean, I know it's part of everyone's core portfolio, the best compounder. You're not going to touch it. But why this underperformance now that the merger is done and dusted?
I think, firstly, I think it's worth emphasizing that HDFC Bank is only underperforming compared to its own stellar history. So if I look at the 2-year compounding in HDFC Bank, and it is a large holding for us, I think 2-year returns have been around 15%. Now, compared to HDFC Bank's history of 21% compounding over 35 years, it does feel that 15 is a weak number, but it's at one level not that bad a situation. Secondly, the merger is the largest we've seen in the financial services sector, and all said and done, they do have to add 1,500 branches a year to keep up with the liability ask, right? Sashi and the team have been very clear about how hard they're working to raise liabilities. They want to replace HDFC Limited's wholesale market funding with CASA funding. People like us believe them that they can do it. We've seen them deliver on the 1,500 branches rollout number over the previous fiscal, and we believe they can do it. But there are other people out there who perhaps don't know HDFC Bank so well and haven't understood the sheer muscle of this franchise as well. They are probably waiting and watching, and we don't mind that. It just gives us that much more opportunity to keep building a big position here. But I think that's the big unknown for the market. Can you pull off this sort of liability ramp up? I don't think any other lender in India, any other bank in India can. But we've seen HDFC Bank do it. Just to sort of remind people who missed the stat, in the quarter ending March 23, a full 25% of India's incremental liabilities went to HDFC Bank. That's the scale at which these guys are ramping up. This is one of India's, I think, when you add up the two numbers, HDFC Bank and HDFC Limited, you'll get a company who will account for 11-12% of the entire country's profits. It's a colossal company now, and perhaps the scale of what's transpiring is not easy for people to understand.
I'd like to draw your attention to the talk of the town, and that's Jio Financial Services. And why am I bringing it up? I know you don't own the stock, but you own a stock which is in the mutual fund distribution, Prudent. If a large business house is looking at creating a financial behemoth which would be based on technology, it will have an edge on distribution, it will have the advantage of skill and scale. What do you think will be the disruptive impact of that on banks which are in distribution, for companies like Prudent which are in the distribution business, for companies like India Infoline which get large part of their business from wealth management? Are we looking at a very disruptive kind of a move coming because of the entry of Jio Financial Services?
I think I'm glad you raised the question. You put in the context of the mutual fund and the mutual fund distribution piece, because I do believe that's exactly where Jio's disruptive impact will be great. I don't think Jio's disruption will be as profound in the lending side, but a combination of Jio and BlackRock, and you put that on a app, and given Jio's well-known muscle in telecom, you can potentially sell a 5-bit Nifty tracker fund to the whole country. So I think there is scope for disruption there. The reason we are not losing an enormous amount of sleep on it is as follows. There are broadly three segments in which the whole wealth management industry operates. The first is affluent people say we've got a crore or more to invest, and the wealth managers, the wealth management arms of the banks or the specialist wealth management houses, 361, Motilal, etc. They cater to that, right? That's the 1 crore plus segment. Then there is a kind of middle segment where people are saving between 5 lakhs to say 50 lakhs, right? 5 lakhs to a crore. That middle class mass affluent segment is where a Prudent is very powerful. I think they've got 100,000 mutual fund distributors, advisors who are catering to that 5 lakhs to 1 crore segment. And then there is I would say, 1 billion people below 5 lakhs. That's where I think Jio will be super powerful. That billion people below 5 lakhs, nobody else has found a business model to get those guys to put in 5,000, 10,000 a month into the stock market. And I'm hoping that's the segment which is basically financialized by this incredibly powerful model of Jio plus BlackRock plus telecom. If that happens, there were 3 markets: the mass market, billion Indians coming into the stock market for the first time, then the mass aff where Prudent is playing, and then there is the wealth managers, the 1 crore plus ticket size investors. And the income tax data is very encouraging for these people. The income tax data shows a 50% growth in the number of Indians filing 1 crore plus returns, 50% compared to 4 years ago. So 3 different strata, and therefore I'm not so sure the players should lose too much sleep. Prudence of the world should lose too much sleep. But for mutual fund distribution, this could be a complete revolution, what's lying ahead of us.
Saurabh, great to have you on the show. Thank you so much for taking the time out and speaking with us as always.